Welcome to the Folio Sightlines blog. I'm Greg Bygrass, President of Folio Institutional, and I'm glad to have with us today Bob Dannhauser, Head of Private Global Wealth Management at CFA Institute. Bob is responsible for CFA Institute's private wealth management initiatives, including content development for practitioners, the positioning of the CFA brand to investors and practitioners in the private wealth space, and development of strategy. Previously, Bob headed the Global Capital Markets Policy area at CFA Institute. Bob, hi, and thanks for taking time to join me today.
Hi, Greg. Thanks for having me.
So today we'll talk about some of the many ways financial professionals can add value to their client relationships. We'll also try to dive into some very helpful CFA Institute research on the challenges and opportunities wealth management practitioners see in their business currently. Because there's a lot of information to cover, we have split this conversation into two parts. You're now listening to part one, and I hope you'll join us for part two. So, Bob, it's an especially dynamic time for wealth managers, with the usual challenges in navigating markets successfully for clients, the potential for new tax laws, technology transforming and perhaps even disrupting the industry, and seemingly never-ending compliance and regulatory burdens. How does CFA Institute see this environment?
Yeah, that's right. For everyone who chose this profession, for its ability to constantly test and challenge one's acumen, this environment is delivering on that promise in spades. Most know us at CFA Institute for our heritage in training professional investors through a significant curriculum and a series of very difficult exams that affirm practitioners' ability to offer individuals expert advice in managing their wealth. And given that, we're naturally very interested in the environment our members practice in and seek to help them do the best they can for their clients on many fronts.
Bob, the Institute recently did some interesting polling that examined some of the dynamics of the wealth management profession. Is a snapshot view like a poll still useful in a time when the pace of change seems to be increasing?
We learned a lot from the work we did over the last year with Scorpio Research to examine how investor clients and wealth managers alike see the world and where the divergent points of view about the value of what wealth managers do are and how those divergencies might evolve in the next few years. And to your point, I think it's interesting and informative to know how values differ now, but I think our members and other wealth management practitioners too find the view of how values in wealth management might be changing in the future to be especially useful as they think about their practices.
So let's dig into some of what you found. Can you tell us some of the specific key findings of the work?
Yeah, sure. To give your listeners some context, Scorpio Research surveyed over 1,000 wealth management practitioners in the U.S. for us, of whom about 70% were CFA charter holders. Slightly more than half worked with what we'll call high net worth investors, which we define as $1 million or more in investable assets, and the rest served mass affluent clients. And along with these 1,000 practitioners, about 3,000 individuals in the U.S. were also surveyed, also a mix of mass affluent and high net worth investors with a median net worth of $2 million. Now, to start, we asked about the challenges and opportunities wealth management practitioners see in their businesses currently. And not surprisingly, the regulatory environment and the potential for non-traditional competitors to enter the wealth management field were at the top of the practitioners' list of challenges. We did find the third most cited challenge to be a little more surprising, and that was the availability of suitably qualified talent, especially in the RIA community. I think that fits pretty well with the idea that enterprise managers are getting older and may not have completely figured out an exit strategy yet. Now, the flip side of that issue was that the third most cited opportunity in the survey, which was business succession and acquisition strategies for inorganic growth, was seen by many of the practitioners in our survey as an opportunity. Just to round out that list of opportunities, generational wealth transfer was the most often cited opportunity, and offering a differentiated value proposition was the second most often cited as an opportunity.
So as a follow-up, you mentioned the entrance of non-traditional competitors. Can you talk to me a little bit about that?
Well, sure. I think there's a lot of attention being focused on potentially some of the technology companies that have already made inroads in consumer marketing to extend their products and their reach into the wealth management space. Robo-advisors are certainly the first iteration of that, but most likely not the last. To date, we haven't seen a big leap by non-traditional investors, or I should say non-traditional advisors, into the U.S. market, but you do see it in foreign markets. So, for example, in China, there are large internet-based vendors who are picking up quite a bit of market share in the wealth management business there, who 5 or 10 years ago heretofore were completely absent from the market. So well worth watching.
One other item you just mentioned that I'd like to ask a follow-up question on is the aging of the traditional practitioner. In many of the conversations I have with advisors as well as with consultants, the issue of succession planning within the business is clearly a big one. Are there any particular strategies or tactics that you've determined or seen through the research that firms are now applying to try to address that issue?
Well, I think what's happened in the last 3 years in particular is just a considerable rise in consciousness amongst firm managers and owners that it's an issue that has to be confronted. I think a lot of people got into this business because of their love of serving clients and their interest in the markets and their love of investing, and didn't really spend a lot of time thinking about managing a large enterprise. And as they've grown to be more successful, considering appropriate and effective exit strategies is something that they're just beginning to realize is important as they reach an age when they think about monetizing their own investment of time and energy into their businesses. So, starting early is probably the best piece of advice that may be, in fact, not so useful for folks who are in their late 50s or early 60s who are already thinking about the best way to exit the business in the next few years.
Bob, maybe a good way to end the first segment of this conversation is to talk a little bit about the next generation of wealth. Attracting that new generation of wealth, creating and marketing a differentiated value prop, thinking about ways to grow their business. These sound like strategies that proactive managers would be adapting. Maybe the right way to think about this is that wealth managers aren't being overwhelmed by all the change at hand. Would that be a fair statement?
I think while that's generally true, our survey results do indicate some degree of misalignment between what investors say they value and how practitioners choose to do business currently. We asked investors how important a variety of wealth management capabilities were, and then asked practitioners about those same capabilities as part of a potential value proposition for their services. Now, practitioners and investors are aligned in valuing some of the same dimensions of wealth management, things like financial planning and discretionary investment management and intergenerational planning. But we do see some gaps with other dimensions where investors put higher value on things like brokerage and banking and credit services and alternative investments, a higher value than that which is ascribed by CFA practitioners. And what that suggests to us is that our members might be overvaluing a few specialties and underestimating the values associated with a more holistic wealth management offering. And, any individual practitioner would likely find it difficult to do justice to the full range of wealth management capabilities. But we think the findings of our survey should cause practitioners to think carefully about their firm's ability to marshal a wide range of resources on behalf of their clients, either through their own organic capabilities or through carefully cultivated relationships with other technical experts.
Thank you, Bob. Listeners, this concludes the first part of our conversation with CFA Institute's Bob Dannhauser. Please visit our Sightlines blog for the second part of our conversation with Bob. Neither Folio Institutional, its parent, Folio FN Inc., or sister companies have a contractual relationship with CFA Institute. Folio has not compensated Bob Dannhauser or CFA Institute in any way for this interview. If you're just joining us now, today we're speaking with Bob Dannhauser, Head of Global Private Wealth Management for CFA Institute. Bob is sharing with us his perspectives on some of the many ways wealth managers can add value to their client relationships. We are also diving into some very helpful CFA Institute research on the challenges and opportunities wealth management practitioners see in their businesses. Bob, let's jump right back in. Is there some risk to trying to be all things to all people and thereby losing the potential benefit of a truly differentiated value proposition?
Perhaps, but maybe that risk isn't as prominent as you might think, at least based on the results from our survey work. For example, we break down the investor responses to the question about which capabilities are most valued by the investor's age. and we do see some interesting divergence in perspectives between older and younger individuals. In general, younger clients seem more interested in more dimensions of a comprehensive wealth management offering, whereas older individuals seem more selective about what they value. So depending on if you're tailoring your approach to one or the other cohort of investors, that might affect which services you offer. But beyond the what of a wealth management offering is the how, and we also see a variety of ways to differentiate practitioner value in that regard.
So for both the what and the how, what about the risk of building a business that's fit for today but potentially not for tomorrow? After all, we started our conversation by noting the changes all around us.
Yeah, that's right. If this was easy, it wouldn't be any fun, I guess. One of the most useful exhibits in the Value of Premium Wealth Management report that we wrote based on these surveys compares the importance of dimensions of a wealth manager's offering both currently and in the next 5 years based on both investor and practitioner opinions. And you see pretty easily the things that clients value now and in the future that apparently aren't perceived the same way, at least by CFA practitioners. There are a few areas of expertise where there's a pretty sharp divergence between what individuals say they think will be important for wealth advisors to be well equipped in the future and what the wealth managers themselves think. For example, inheritance planning and behavioral finance, both areas in which CFA practitioners think expertise here will be much more important in the coming years than what investors report. The most striking gap to me was around sustainable investing, where investors said they thought wealth managers needed expertise both now and in the future, but CFA practitioners were far more moderate in their estimate of the need for that kind of expertise. And that fits with some anecdotal evidence I've acquired in my travels that has at least some wealth managers thinking sustainable investing is likely to be a fad.
Interesting. We have seen a lot of discussion and interest recently around both the sustainable, responsible investing as well as the environmental, social, and governance aspects of investing. And significantly, we're seeing a lot of the emphasis and a lot of the drive around that really coming from the emerging client segments, the millennials clearly, as well as more women heading up investment households. Any of that consistent with your findings or the conversations that you've had?
It's certainly consistent with the conversations I've had, and in some ways it's sustainable investing coming full circle from where it started back in the 70s and 80s, where people were very interested in aligning their portfolios with their values. Along the way, we've had, socially responsible investing graduate to be a somewhat larger discipline that focuses on ESG and social impacts along with financial impacts. But it's really that fundamental motivation to be comfortable with the portfolio and be comfortable with the source of returns that seems to be motivating a lot of millennial investors these days. That's kind of interesting to us because from the institutional side, what we've seen move the needle in terms of adopting sustainable investing has been a much more deep appreciation of that style of investing's ability to contribute to effective risk management. So not just looking at it as a source of alpha, but thinking about it in terms of evaluating quality of management and identifying risks such as climate risk that might have material impacts on financial performance down the road. I think millennials have an appreciation for that, but that may not be sufficient to motivate them. It's really that embracing of the value of what they're investing in that seems to be what they're talking about with our members most often.
Interesting. Thank you, Bob. It's been a pleasure speaking with you today, and I think you've provided some really terrific insight that our listeners are going to value.
Thank you, Greg. It's been my pleasure.
If you'd like to receive more insightful tips about growing your business, sign up for Folio Institutional's blog at info.folioinstitutional.com/blog. Neither Folio Institutional, its parent, Folio FN Incorporated, or sister companies have a contractual relationship with CFA Institute. Folio has not compensated Bob Dannhauser or CFA Institute in any way for this interview.